Hi there, this is Utkarsh Jain, and purpose of this presentation is to understand key differences between US GAAP and IFRS. This video presentation has been divided into two parts. The section that you see in the green here, those are the differences which would be covered in the part 1 of this video series, and the sections in the blue would be covered in the part 2 of the video series. Now, the items that you see which have been highlighted in yellow, like these ones or the one here, these are the ones which are typically considered more important from the perspective of the exams. So let us start. The first thing that we go through is the overview. Now this is actually the building of International Accounting Standard Board. So which are the issuing bodies? We know that IFRS is issued by a body called International Accounting Standard Board, and with IFRS are kind of the international rules, and US GAAP are issued by a body called Financial Accounting and Standard Board. So IASB and FASB. Moving further, what are the principal setting approaches? Now, if you understand this point number 2 well, it will help you remember a lot of differences in US GAAP and IFRS automatically. So generally, US GAAP have been developed using a rule-based framework. Okay, so what does it mean? It means that US GAAP will generally go into nitty-gritties and define rules for most of the subparts or subcomponents of accounting, whereas IFRS have been generally developed using a principle-based framework. Okay, so what it means is that IFRS, they would try to achieve, so they want accountants to do an accounting in a particular fashion. So rather than going into nitty-gritties, they would generally define it in a larger scale. So these are principle-based and US GAAP is rule-based. The third point, what do you need to know for the exams? So please remember this. In case if an exam question on CFA Level 1 does not specify whether we should use IFRS or US GAAP, then the default accounting standard that we have to use is always the IFRS. So moving further now. The first difference that we see is statement of comprehensive income. So in IFRS, income statement can be combined with OCI and we can prepare a combined comprehensive income statement, or we can also present them separately. So we have some flexibility, and exactly the same set of flexibility is also available in US GAAP. Okay, so technically this is not a difference. However, US GAAP has one more additional set of flexibility, which is the firms can choose to report comprehensive income in Statement of Shareholders Equity, which means the firm can also decide to include comprehensive income within the Statement of Shareholders Equity. Now, I do not think that this is a really important difference to be remembered from the exam perspective. However, what you need to understand is that income statement, which means profit for the year, plus the other comprehensive income is actually the comprehensive income. Let's look at these statements of Unilever Group. Unilever Group does accounting on IFRS. This is their consolidated income statement for the year 2013, 12 and 11. And then typically we have operating profit, all the expenses, and then this is where we have the amount of net profit. Now, we also have the consolidated statement of comprehensive income of the same company. And what you can observe here that it starts with net profit, but it also includes other comprehensive income. And then this is where we get total comprehensive income. So please remember this for your exams, that net income plus other comprehensive income is equal to comprehensive income in both US GAAP and IFRS. Moving further, elements related to performance. So performance is typically measured on the income statement, and in IFRS these elements related to performance are simply classified as either an income or an expense. However, US GAAP is generally more detailed, so it would classify them into revenue, expenses, gains, losses, and comprehensive income. So what is the trick to remember this? The trick is that US GAAP is generally more detailed, since we know it is a rule-based framework or approach. So please remember elements related to performance, income and expenses in IFRS, whereas in US GAAP it would be revenue, expenses, gains, losses, and comprehensive income. Let's move further. Definition of asset. IFRS, resources from which future economic benefit is expected to flow. Whereas in US GAAP, assets are probable economic benefits obtained or controlled by a particular entity. Okay, so again, I would not, for the CFA Level 1 or Level 2 exams, I would not try to remember these definitions. But yes, what you might want to remember is the fact that US GAAP uses the word probable in the definition of assets and liabilities. Let us move on further. Revenue recognition criteria for sale of goods. Now, generally, this is an exception to the rule that US GAAP is more detailed. In this case, IFRS has a comprehensive list of conditions to be satisfied. So, condition number 1 for revenue recognition in IFRS, risk and reward has to be transferred. Number 2, no control over the goods. Number 3, revenue reliably measured. Number 4, probable flow of economic benefits. And number 5, cost can be reliably measured. Whereas in US GAAP, we just have 2 rules. Revenue is realized or realizable, plus it has been earned. Okay. So, alright, again for the exams, I don't think you need to remember all the 5 points in IFRS and US GAAP. Just remember the 5th point in IFRS, which says that cost can be reliably measured. So, imagine a scenario where it is difficult to measure cost of a particular good which has been sold. In that case, it is not satisfying the revenue recognition criteria, and therefore maybe the revenue recognition should be deferred. Alright, so let's move on to subsequent point, long-term contracts. Now the sections that you see in gray here, these are the sections which are common between IFRS and US GAAP, and the section in green and blue are the differences. So let's look at the common areas first. IFRS, where an outcome can be reliably measured, we use percentage of completion. The same logic works in US GAAP, outcome reliably measured, percentage of completion. Then at the bottom, if a loss is expected, recognize loss immediately. Loss is expected, recognize loss immediately. Alright, so I think again this is something you would want to remember. You see a project where total revenue is, let's say, 1000 over the period of 5 years, and total expected cost over the period of 5 years is 1200. Then irrespective of which accounting framework you are operating in, that means whether it's IFRS or US GAAP, entire loss of 200 has to be booked today itself. Okay, so recognize losses immediately. Now let's look at the key difference between these two. When outcome can't be reliably measured, IFRS says revenue is recognized to the extent of cost, and costs are expenses when incurred, profit recognized on completion. However, as against it in US GAAP, when outcome can't be reliably measured, the method that we use is completed contract method, where revenue, expenses, profit is recognized when the contract is complete. And I think the best way to understand this is through a small example. So let's look at an example here. Assume that XYZ Construction Corporation has a contract to build an office building for $500 or $5,000, and a reliable estimate of the total cost is $4,000. So this is the schedule of estimation: 2014, 15, 16, 2,800, 1,200, total 4,000. If outcome cannot be reliably measured, determine the profit. In fact, in this case, let's say can be reliably measured. Determine the profit and revenue under US GAAP and IFRS. If the outcome can be reliably measured, we know that both IFRS and US GAAP uses the percentage of completion method. So how do you calculate percentage of completion? Total cost 4,000, out of which this year we have spent 2,000, which means the proportionate cost spent this year is 50%. Cost is 800 in 2015, total cost 4,000. So 800 as a ratio to 4,000 would be 20%, and 1,200 as a ratio to 4,000 would be 30%. So 50 plus 20 plus 30, total is 100%. Once we have percentage of completion, then total revenue of 5,000 multiplied with 50% would give us 2,500. 5,000 into 20% would give us 1,000. 5,000 into 30% would give us 1,500, and that's how we would recognize a total revenue of 5,000. Cost is 4,000, which is the schedule is available with us. So 2,800 and 1,200, total cost of 4,000, and therefore the profit of 500 in year 1, 200 in year 2, 300 in year 3, and total profit of 1,000 over the period of 3 years. So straightforward, percentage of completion method. Let's see what if the outcome cannot be reliably measured. If outcome cannot be reliably measured, we know that in US GAAP we use completed contract method. Completed contract method. Okay, so let's see how the accounting is specifically done. In case of IFRS, the revenue would be same as the amount of cost. So this is 2000, this would be 2000, profit is 0. This would be 800, this would be 800, profit is again 0. And then the entire profit is to be recognized the year in which the project is to be completed. So again in this case, the total revenue that we would book in the final year would be 2200. The cost that would be recognized in the final year would be 1200, and therefore the profit that would be recognized in the final year would be 1000. And therefore your total revenue automatically came to 5000, total cost came to 4000, and total profit is 1000. In US GAAP, revenue in year 1 0, cost in year 1 0, profit in year 1 0. Same is the case in 2015. In 2016, we will recognize the entire revenue of 5000, entire cost of 4000, and therefore we will recognize a profit of 1000 in the final year. Let's move on further. Barter transaction, IFRS. Revenue must be based on fair value of revenue from similar non-barter transaction with non-related parties. So which makes sense. So let's say that we are accounting for company A, and company A has given certain goods to company B. So let's say a good X, and it has received some good Y. Now, if company X can find out, company A can find out the value of this good X in a non-barter transaction with non-related party, then it can simply recognize the amount of revenue there. US GAAP, however, says it puts a relatively more stricter condition that revenue can be recognized at fair value only if firm has historically received cash payment for such goods and services. Okay, which means if firm A has not been able to do a transaction like this in the past, or firm A has not sold that good X for cash to some other firm in the past, then it would not be allowed to recognize the revenue. And then again, what is the memory trick to remember this? The round tripping transactions. Okay, so historically in US, a lot of online companies, let's say a company A and company B, they sold advertisement spots to each other. So company A's website would advertise itself on B, and B would advertise itself in A, and in process they could inflate the revenue. And therefore, to ensure that such kind of practices do not happen in future, the revenue is now the laws have made, or the accounting standards have been made more stringent. So revenue can be recognized at fair value only if firm has historically received cash payments for such goods and services. Let's move on to next point. Extraordinary items. If an item is unusual or infrequent, it is to be included in income from continuing operations in both IFRS as well as US GAAP. However, if an item is unusual and infrequent, then it is considered extraordinary in US GAAP, and therefore it has to be reported separately in the income statement net of tax after income from continuing operations. However, IFRS does not allow extraordinary items reported separately, which means if an item is unusual and infrequent, even in that case in IFRS it has to be shown as a part of income from continuing operations. It will not be allowed to disclose it separately. We can look at a practical example to internalize this concept. Let's look at the consolidated income statement of JP Morgan & Chase, which actually uses the US GAAP. Now, this is revenue from different sources. These are different costs, non-interest expenses, income before income tax and extraordinary gain. This is income before extraordinary gain, and look at this item carefully. It is an extraordinary item net of tax, a smaller amount. However, it has been shown separately after the income from continuing operations. So let us move further. Balance sheet presentation, an important point from the exam perspective. What are the items which are same in US GAAP and IFRS both? It requires current and non-current assets and liabilities to be reported separately. Same condition in US GAAP, and this is called as a classified balance sheet. Okay, so what is a classified balance sheet? If current assets and non-current assets have been classified separately, then it's a straightforward classified balance sheet. Both US GAAP and IFRS require balance sheet to be classified. One exception which is allowed in IFRS is the liquidity based presentation. Okay, so how you want to think of this is that liquidity based presentation, so let me call this as LBP, is opposite of classified balance sheet, which means in liquidity based presentation there would not be a bifurcation of current assets and non-current assets. So on the exam, if they have given you a small section of balance sheet and you see that there is no classification between current assets and non-current assets, then you would know that the company is an IFRS environment because it is using a liquidity based balance sheet. However, liquidity based balance sheet is mostly used by the banks. So let's look at an example of liquidity based balance sheet. This is balance sheet of China Construction Bank, year 2009-2008. And if you'd see, we have cash, deposits, precious metal. That means we haven't really bifurcated the assets into different sections. This is called as a liquidity based presentation. As against that, if we have, this is balance sheet of Coca-Cola. If we have current assets and if we have non-current assets here, then in that case, this is called as a classified balance sheet. Now, let's look at what is the difference between IFRS and US GAAP for balance sheet presentation. I'm going to read the US GAAP section first. Generally, companies using US GAAP order items on the balance sheet from most liquid to least liquid, which means if it's a classified balance sheet, typically US GAAP will have current assets first, and then at the bottom it will have non-current assets. IFRS does not specify the order in which current or non-current assets should be presented. Generally, companies using IFRS order balance sheet information from least liquid to most liquid. Okay, so I think this is a really important point from the exam perspective. So please remember this. If you see a balance sheet where we have non-current assets at the top and then current assets at the bottom, then you can imagine that this is a company which is operating in IFRS environment. However, if you have a balance sheet where you have current assets at the top and non-current assets at the bottom, then you would know that company is operating in a US GAAP environment. Let's look at examples of each one of them. Now, this is balance sheet of Unilever Group, which is of course operating on the IFRS environment. And if you'd see that we have non-current assets and generally the most illiquid asset at the top, which is goodwill. And then at the bottom, what we have here is the current assets, which means we are starting from less liquid to more liquid assets. As against this, let's look at the balance sheet of Coca-Cola. Now, in this case, we have current assets at the top and we have non-current assets at the bottom here, goodwill being or other intangible assets being the last, which means we are starting from more liquid and then towards the less liquid. So this is US GAAP. Let's move on. Now the next item of comparison is on the cash flow statement. Again, an important point from the exam perspective. Now certain items are classified differently in IFRS and US GAAP. So let's first look at the US GAAP carefully. Dividend paid CFF, interest paid CFO, dividend received CFO, interest received CFO, taxes related to operating activity CFO, taxes related to financing activity CFO, taxes related to investing activity CFO. So there's a really simple memory trick to remember the treatment on US GAAP, that except dividend paid, which is CFF, everything else in US GAAP is CFO. And dividend paid, remembering that point is easy because we are paying dividend because we have taken equity shares. And receiving or taking money through equity shares is CFF, therefore dividend paid has to be CFF. All other items are CFO in US GAAP. In IFRS, the memory trick is that all the items are either CFO or they are logical. Okay, so dividend paid CFO or something. So let's look at this carefully. Dividend paid CFO or what's logical? We are paying dividend because we have taken equity share and therefore CFF. Interest paid CFO or what's logical? So we are paying interest because we've taken bank loan. So again CFF. Dividend received CFO or what's logical, which is CFI. We are receiving dividend because we invested in equity shares. Interest received CFO or again CFI. Right? So should not be very difficult to remember this. And then in case of taxes, the memory trick is simply to remember that it's logical. Operating is operating, financing is financing, and investing is investing. Straightforward stuff. So let's move further. Cash flow statement presentation. US GAAP encourages the use of direct format. IFRS encourages the use of direct format, right? So this is the same point on both IFRS and US GAAP. Now, since the wording which is being used is encourages, which means both IFRS and US GAAP allow to use either direct or indirect. However, US GAAP imposes a restriction. What is the restriction? If a direct method is used, a firm must add a disclosure in the notes of indirect method. Okay, which means if a company has decided to use direct method of cash flow from operations, then in the notes to accounts, they will also be required to show the cash flow from operations using the indirect method. And then generally, most of the companies would not use direct, they would simply use indirect in US GAAP. And again, it's not very difficult to remember because from an accountant's perspective, if you make direct, you still have to make indirect in the notes to account. So why not simply make indirect, right? So please remember, US GAAP, if you make direct, you have to disclose indirect in the notes to account. There is no such disclosure requirement in IFRS. Moving further, inventory valuation. This is a point that most of the candidates would remember automatically, that IFRS does not allow LIFO, whereas it allows all the other methods. US GAAP allows LIFO. Now, because US GAAP allows LIFO, we have a concept of LIFO reserve. So what is LIFO reserve now? Generally, we know that if you are operating in an inflationary environment, the LIFO COGS would be higher than FIFO COGS. And since LIFO COGS would be higher, LIFO inventory would be lower than the FIFO inventory. So imagine a scenario that LIFO inventory is 100, FIFO inventory is 150. Every firm is required who is using LIFO in US GAAP is required to disclose in the footnotes that had the firm not used LIFO, had they used FIFO, then the value of inventory would have been higher by 50 on the balance sheet, and this 50 is called as LIFO reserve. Okay, so what is LIFO reserve? It is simply the difference between FIFO inventory and the LIFO inventory. Let's do a comprehensive example to internalize this concept. So we have a small schedule here. We have a company which has started business in year 1, year 2, year 3. Inventory purchases, in both the cases it is 1000, it has to be same at the beginning. However, in the first year itself, the LIFO cost of goods sold is 500, whereas FIFO cost of goods sold is 300. Okay, and again it makes sense because we know generally in inflationary environment, LIFO COGS would be higher than FIFO COGS. Now, because of which 1000 minus 500, closing inventory 500, 1000 minus 300, closing inventory 700, 700 minus 500, LIFO reserve in the first year is 200. Okay. Now, if you can see, the difference in two COGS at this stage is also 200. That LIFO COGS is higher than FIFO COGS, and that is the reason why the closing inventory values are different. Now let's move on to next year. Now closing of this year is going to be the opening for the subsequent year. So 500 minus 200, 300, 700 minus 100 is 600. Difference of these two is now 300. And what you would appreciate is difference in two COGS in this year is 100. Okay. So what we want to learn here is that this difference in two COGS is the reason why LIFO reserve is increasing every year. So this year difference in COGS was 100. Last year LIFO reserve 200. 200 plus the difference in two COGS 100 has caused LIFO reserve to be 300 this year. Let's see if the same logic works next year. 300, 300 here. 600 closing of FIFO, 600 here. Now the COGS is 250 and 100, and therefore closing inventory 50 and 500. we can directly calculate LIFO reserve should be 450. Last year LIFO reserve was 300. This year LIFO reserve is 450. LIFO reserve has increased by 150. This has to be the difference between two COGS this year, 250 and 100. Okay, so based on this, what do we learn? What we learn is that FIFO inventory minus LIFO inventory is actually the LIFO reserve. Okay, and LIFO reserve every year increases because of the differences in two COGS. So therefore, if you say LIFO COGS minus FIFO COGS, this is the amount by which LIFO reserve will increase. So this is the amount by which increase in LIFO reserve. In case if you've not understood this example, please take a screenshot of this presentation right here and then make sure you spend some time, because generally this is one of the interesting or popular areas where question could be tested. Let's move further. Now this is an example. This is a notes to account of Ford Motor Company, which is actually operating in a US GAAP environment. Now all inventories stated at lower of cost to market. Cost for a substantial portion of US inventory is determined in LIFO basis. LIFO was used approximately 32% of total inventory. Cost of other inventory determined by costing method that approximates in a first in first out basis. So we have a total inventory value given under FIFO. However, we also have a LIFO adjustment of 928 and 865, and these numbers are nothing but the LIFO reserve, so that we have a total inventory here. Moving further, inventory write down. Again, an interesting area which will require you to remember a few stuff. So inventory write down, the rules are slightly different in IFRS and US GAAP. In IFRS, we take lower of cost or net realizable value. And how do we calculate net realizable value? It is selling price minus the selling cost. Now, in case of IFRS, subsequent recovery is allowed to the extent of previous write down. And we know this, that generally IFRS will allow you to take the value of asset upwards, whereas generally US GAAP will not allow to take the value of asset in the northward direction. Let's see how it works in US GAAP environment. Again, we have to take lower of, but this time cost or market. And this market has also been referred to as the replacement cost. However, US GAAP also puts a condition that this market or replacement cost has to be in a logical price band. And what is that price band? That price band is net realizable value on the higher side and net realizable value minus a normal profit margin on the lower side. Okay, so a quick example will help us internalize this concept. And yes, in US GAAP, subsequent recovery is not allowed. So let's look at an example. FT Corporation sells mobile phones. Per unit cost information pertaining to inventory is as follows. Calculate carrying value of inventory under US GAAP and IFRS. Let us first do it under IFRS. So try to recall the flowchart of IFRS. In IFRS, the comparison is to be done between cost versus the net realizable value. And we know that net realizable value is nothing but selling price minus the selling cost. So what is the cost of the inventory given? Cost is given as 500. The selling price is given to us as 450. However, we might have to give some commission or some brokerage when we sell our goods. So let's say the selling cost is 10 and therefore net realizable value is 440. Now cost or net realizable value, whichever is lower, in this case 440 is lower. Therefore, we will have an inventory write down of 60, and the inventory on the balance sheet would be shown at a value of 440. Let's see how the accounting would be done in US GAAP. So again, try to recall the flowchart we saw on the previous screen. Original cost is 500. So this is your cost. This is to be compared with the replacement value, also called as market. So what is the replacement value? The replacement cost is given to us as 420. However, US GAAP imposes one more restriction, that this replacement value has to be in a price band. On the higher end of the price band, we have net realizable value. Net realizable value is selling price minus selling cost. So in this case, The selling price is 450 and the selling cost is 10. Therefore, net realizable value is 440 on this side. So this is NRV. And on the lower side, we will have net realizable value minus a normal profit. Normal profit margin is given to us as 40. So therefore 440 minus 40, this would be 400. What we have to ensure is that this replacement value has to be between a price band of 400 and 420. Now in this case it is. Imagine a scenario if replacement value was not 420, had it been 380, then we would have used, had it been 380, then we would have used 400 in case of that replacement cost of 380. If the replacement cost was 450, then we would have used 440. But since in this case 420 is between 400 and 440, we use it as it is. Therefore, we will have an inventory write down. So inventory write down would be of 500 minus 420, 80, and inventory value to be shown on the balance sheet would be 420. Let us move further. Alright, so this is where part 1 of this video series gets over. Hope to see you again in part 2. Thank you.